Coming up today, stocks start the week higher, the looming government shutdown, why this could be an issue, how October is stacking up, the wake-up call from the Walmart CEO, the strongest stocks in the market, and why global asset momentum is on fire. We're going to have another great week, guys. Let's go. And welcome back, guys, to the Daily Market Review. Off to a great start this week. Hope you're doing well out there today. Our portfolios certainly are, as we've got global asset momentum on fire. Just looking at the ETF heat map here today. Different asset classes. Crypto really picking up. Commodities still going on a run, led by the miners. We've got China continuing to break out, and we've even got bonds up there today, with quite a bit of bullish breadth across the US market, bar energy, oil and gas. And overall, the S&P 500 finishing slightly up, 0.26%, really not off all-time highs here, sitting right at 6,700. And September has been a fantastic month for momentum strategies. We can see that in this data here, showing momentum the best performing investment factor relative to the S&P 500 month to date. And this is just within the US market. We've actually got a lot of momentum all around the world. And that's thanks to a few things. None the least, we're well and truly in a global interest rate easing cycle. Central banks around the world cutting interest rates, lowering the cost to borrow, and that helps to stimulate economies. Last two times we're at this level of global easing, June 2020 and October 2009. And they were actually fantastic entry points into the market, as we had already come off the bear markets prior to that. And so we've got a massive global easing cycle, whilst economic and corporate growth continues to hold up, if not accelerate, in addition to global liquidity continuing to rise. Just looking at a chart here of M2 money supply here in the pink line, almost $113 trillion out there. Looking at data from the top 21 central banks around the world. Here in the blue line, the year-over-year growth in global money supply. And that includes cash, checking and savings deposits, and money market accounts. You could kind of think of it as liquidity sloshing around the system, and that year-over-year growth has recently broken out to a multi-year high. You can see back in the bear market 2022, it was really contracting, along with the softness we got in late 2018 into 2019. Then that big liquidity boom coming out of March 2020 really helped to propel global assets higher, including Bitcoin here in the white line, actually having a strong correlation with global liquidity. And so basically, with global easing and liquidity on the rise, that indicates major central banks are making more money available to their economies. And that's a strong structural tailwind for asset prices. Basically, everything gets inflated. And even though the S&P 500 was slightly up today, thanks to global momentum being on fire, my ETF portfolio is having another monster day. Now up over 12% for the month of September, and stick with me later because I'll explain exactly how my ETF momentum investing strategy works, and I'll give you a look at my portfolio analytics. And why it's a great time to start a global momentum portfolio is because yes, we do have plenty of momentum in US stocks, but just keep in mind the US stock market is at record valuations. This data is a couple of months old, and S&P's up about 5% or so since late June. So the current ratio of the US stock market to US GDP is about 220%, an all-time high. Even though you can see in this chart here, the historical trend line is in a secular uptrend. Valuations go higher over time. We're still more than 2 standard deviations above that trend line. So no doubt the US stock market is vulnerable to reversion to the mean over the coming years. But crazy could get crazier, as nobody knows for sure when the top will come, but we do have signs of corporate insiders starting to cash in. Looking at the ratio of insider sales to buys, currently sitting at very elevated levels. Last time we saw that was back in January, before stock indices sold off 20 to 30% going into April lows. Corporate insiders know their stocks better than anybody else. They're pretty good at buying the dip, selling the rip. But again, that's just for US stocks, which no doubt are at historical valuations. Looking at the rest of the world, some of them are even cheap, emerging markets in particular. Only on a forward PE of 13, implying a forward earnings yield of over 8%. Whilst again, we're in a global easing cycle, interest rates coming down. That makes the yield on stocks more appealing, in addition to lowering the cost for consumers and businesses. Just looking at the yearly seasonality calendar, today was the 29th. The market finished a little bit up, but tomorrow could be interesting. Not only the last day of the month, the last day of the quarter, but also the last day for the US government to avoid a shutdown, which doesn't look likely at this stage. In fact, prediction market odds are now pricing an 82% chance the US government will shut down by midnight Tuesday as we go into Q4 on Wednesday. And typically, this is no big deal for the stock market. During past government shutdowns, we didn't really see any big sell-offs. We actually saw a slight bump up the week after a shutdown. But this is going to coincide with the all-important jobs report that we get on the first Friday of every month, scheduled for this Friday. If government workers aren't at their desks, it could interrupt the release of the September jobs report, which is going to play a key role into the Fed's next interest rate decision. Scheduled for the 29th of October, economists are estimating the US economy has generated 50,000 new jobs for the month of September. And this is what prompted the Fed to cut rates this month for the first time this year. So the jobs number will be important along with the unemployment rate. Polymarket saying we're likely to come in at expectations of 4.3%. And now since inflation isn't currently an issue, in fact, Trueflation came out today and said that inflation in the US economy is continuing to downtrend, currently around 2%, looking at over 10 million prices across the economy in real time. And so regardless of the jobs report, even if we don't get it, I don't think the market's going to mind all that much. We should still be getting an interest rate cut later next month. Fed Fund Futures got it at 90% and potentially another one in December, but we've still got to get through a few more CPI inflation prints. Remember, it's jobs first, inflation second that goes into the Fed's decision making. And even though we did see a bit of a bump up in options pricing today, volatility markets still don't seem all that worried. The VIX 9-day at 13.5. Again, isn't pricing in any fireworks this week. And if the jobs market doesn't fall off a cliff, we could still very well be following a non-recessionary path where the Fed can gradually bring rates lower, helping to retain economic and corporate profit growth. In that scenario, stocks can do really well. If the economy holds up and we get interest rate cuts, stocks can be 50% higher 2 years later. Of course, if we do get a recession, it's a different story. Stocks can be significantly lower 2 years later. And so September in Q3 ends tomorrow. Coming into it, the bears were shouting from the top of the mountain, this is the month we're finally going to pull back. Historically the worst month of the year. No doubt that's what the seasonality shows, but that's just one piece of the puzzle. It doesn't always play out according to the seasonal calendar, and the market is still having one of its best recoveries after a correction ever. Here in the black line, now about 120 days off the lows. The only prior recoveries that performed better were 2020, 2009 in the brown, and 1982 in the green. Interesting to note, most of these recoveries went on for a few more months before having the next 8% correction. But you can see after a few more months, the returns start to plateau. And that's what you typically see at turning points in the market. Prices will consolidate, stall out. We get those double tops, divergences, breach the trend lines and moving averages, then it can roll over. But seasonally speaking, we are going into the most bullish quarter of the year, and that is Q4, which finishes higher 80% of the time with an average gain of 4.2% for the S&P 500. And even though we are a bit technically overbought here, with the S&P 500 about 10% above the long-term 200-day moving average, looking back over the last couple of years, we have seen higher extremes, getting up to 15% there in mid-2024, which if we did the same now would imply about 6950 on the S&P 500. Very well could see 7,000 late this year or early next year. And even though Q4, seasonally speaking, is the best quarter of the year, not so much for October, especially after the S&P has already had a great first 9 months, up more than 10%. When that happens on average, October is a slightly negative performing month, only higher 50% of the time, but we still usually get a positive Q4 when we've already got significant momentum in the first 3 quarters of the year. And for some reason, we always tend to get surprises in October. Volatility-inducing events. Some of the most famous being Black Monday 1987. S&P 500 came off 20% in one day, and also the big crash in 1929 happening in October. October 2008 was one of the worst months for the stock market ever. And even outside of those years, volatility for October is still 33% above average for the other 11 months. And we are going into a blackout period for most S&P 500 companies as we get into the thick of Q3 earnings, kicking off in 3 weeks from now, as we always do in the first month of every quarter. As companies report on their prior quarter, they're typically barred from buying shares, either for themselves or the company going into earnings, typically waiting for after earning to allow corporate purchases. And that's a big structural tailwind of the market. Companies scooping up billions of dollars worth of their own shares every day. And so come mid-October, over 80% of companies will be in a buyback blackout period, which if the market did want to dip, it could dip a little more because that dip won't be getting bought by most companies. But just to keep it interesting, we haven't had 3 down Octobers in a row for a long time. We'd have to go back to the late 70s when they had 4 Octobers down in a row. And the last 2 Octobers in this current market were down. So again, just a bit of interesting seasonality, but don't base your entire portfolio off this stat. And something else that could add to market fragility is so many investors are nervous and on edge about US tech stocks. For every person that says we're in a secular AI bull market, there's another person that says we're in a massive bubble that's going to pop any day or week now, big and small investors, with plenty of similarities being drawn against the late 90s. Some charts show we could be around 97, others around 98, and like this one here, suggests we could be somewhere similar to early 1999, after the market had a big sell-off in late 98 as well. And maybe we could be following this path, for which we would need an epic blow-off top to really see the end of this AI bull market when everyone piles in, when all the bears throw in the towel, for which there is still many. Maybe then we can see a top in US tech stocks. Because there is a big overwhelming narrative, even across investment banks, that the AI bubble is the only thing keeping the US economy together. Now, I'd say that's a pretty dramatic claim, but there is some data to show that tech spending has really helped the US economy avoid a recession, like the yield curve started pricing in a few years ago. I think it's safe to say it was different this time. The fastest Fed rate hiking cycle in history, which typically always causes a recession. Like I've been saying, the AI boom simply overwhelmed it. Not to mention, I still think excess liquidity generated in 2020 is still having an effect on financial markets. And now we've kind of moved past that economic cycle and we're back to global easing and global liquidity on the rise. And according to a lot of data, the recession has already come and gone. Even though I know, yes, millions of consumers are still struggling with structural inflation. Unfortunately, non-asset owners have been left behind somewhat. And that could exacerbate if the Walmart CEO is right, issuing a wake-up call on Friday that AI is going to change literally every job. As America's largest employer, says headcount is expected to stay flat over the next 3 years, despite growth plans as AI eliminates or transforms roles. They plan to maintain their global workforce of 2.1 million over 3 years, but the composition of jobs will shift significantly. The company's developing AI tools, such as chatbots, creating agent builder roles, while automating more warehouse and back of store tasks. In other words, the makeup of their jobs is going to go from low skill to high skill, with AI engineers and systems developers, whilst warehouse jobs will be getting replaced by robots, just a matter of time. And so we're hearing it straight from the horse's mouth. The world's largest employer, not just in America, isn't planning to expand their workforce, and they very well could decrease it. And you can be sure they'll still keep growing sales. It's going to squeeze profits higher, but it could also open up room to actually decrease prices. AI could turn out to be massively deflationary. And all these big AI companies are trying to scale up at light speed. In fact, ChatGPT maker OpenAI is planning to 125x their energy capacity in 8 years. That would mean using more than India's energy capacity today, the second most populated country in the world. Potentially going to consume 250 gigawatts by 2033. They're hoping to finish this year on 2. To put into context, the UK has about 35 gigawatts of capacity today. This is massive. Single companies' energy consumption going to overtake entire developed economies. And so apart from AI companies themselves, the second best way, and in fact it may even turn out to be the best way, to play the growth in AI is from the huge demand in energy and electricity going forward. With the US utility power demand from data centers expected to more than double just over the next 5 years through to 2030. And so there's many ways to play this. In fact, my most recent stock pick I just sent out to members on Sunday is set to benefit from this circular trend, as are many other companies involved in building out the grid, electricity generation, uranium supply and enrichment, power and cooling, long duration storage, and also batteries as well, as we move more and more into physical AI. And that's the thing, these hyperscalers have the cash to do it. That's the big difference between now and the late 90s. These companies are absolutely printing cash, looking at the net income margins. In addition to rock bottom investment grade credit spreads, allowing them to tap debt markets, they're just scaling at will. They've got the cash flow, the debt, and the full support of the market to do so. And so there's still well and truly a compute power arms race that many of the infrastructure providers like Iron are set to massively benefit from. And what's interesting now is some of these big tech companies like Microsoft can actually borrow at a lower cost than the US government, with Microsoft bonds offering a slightly lower yield than treasuries with the same duration. And that's because Microsoft's balance sheet is far more healthy than the US government's. Looking at debt to equity, looking at debt to income, investors feel more safer lending to Microsoft than the US government, which no doubt gives them a huge material advantage. Just moving on, looking at the IBD 50, Investor Business Daily's latest list of the top growth stocks in the market according to their unique ranking system, looking at earnings growth, price action, and other factors. Coming in number one again, Iron. And nice to see along with Iron, there's also InnoData and Symbotic, 3 stocks we hold in our stock picks portfolio, showing up in the top 15 IBD list. Is nice to see as some of these hot AI related stocks just continue to power ahead, with Iron up another 9% today, InnoData up over 7%, and warehouse robotics maker Symbotic up over 3%, still looking good on the chart here. With our entire stock picks portfolio up almost 3% today. Plenty of momentum in small cap stocks, and some others I've mentioned here recently. BlackBerry doing very well on Friday, putting on another 6% after it came out with a really good earnings on Thursday, and another stock I recently shared on the channel. Grail having a monster day, up 17%, along with the cannabis ETF, as Trump just recommended CBD oil for seniors. We're still waiting on rescheduling, but the trend looks to be intact, and that helped me and my options members have another very profitable day in the market, as I'm currently long MSOS as part of a wheel play. I sold puts on them, got put the ETF, then I've been writing covered calls, collecting premium in addition to profiting on the long ETF position. It's a really great strategy. Along with my ETF portfolio having a great day, and since I only opened this service for the first time on Thursday, launch week lasts until this weekend, giving everybody a chance to get on board with a 40% discount until this weekend only. And so for those of you who weren't watching the show last week, I'll show you exactly how my global momentum strategy works. And so first off, I only invest in long, unleveraged, and liquid ETFs that trade millions of dollars worth of units every day. And that's approximately 1,000 to 1,200 US listed ETFs. Then my unique momentum formula scores every ETF according to performance, volatility, and a few other things that I've tested for robustness. Within the top 100 ranking ETFs, my portfolio will buy new ones, always holding 10 of the highest ranked ETFs equally weighted, with 10% of my account in each. And so it's just a few minutes each month on the first trading day, and there's no need to look at it for the rest of the month. I come back the next month, perform steps 1 to 3 again, and I'll typically sell between 1 and 5 ETFs and replace them with others, always rotating out of weakness and into strength, whilst always holding a globally diversified portfolio. And I've got hard limits on risk exposures, maximum 30% of the portfolio in any one category, and a maximum 50% of the portfolio in the United States, with a maximum 25% on every other country. And why I allow a higher maximum in the US is because 65% of the world's market cap is US stocks, and a lot of US stocks are actually global in nature. Many of them actually have more revenue outside the States than they do inside. So naturally, the States will always have the largest allocation, but like I said, I do keep limits on that and like to have diverse exposures around the world, along with a hard 35% limit on sector exposures. So the portfolio does allow some concentration. So if there's a really strong trend within one sector, the portfolio can still benefit, but within limits. I never want 50% of my portfolio or anything like that exposed to one sector. Again, always having a good mix throughout. Also in the members area is a position sizing calculator. For example, I can enter my current account value. As I'm starting this strategy with $100,000 this Wednesday, I'll be buying 10 ETFs, 10% in each. Let's say the current ETF price was $23.42. That would mean I'm buying 427 units of that ETF. Then I just do the same thing again for the 9 other ETFs that I'll be buying this Wednesday. And so if you're interested in joining the ETF portfolio service and saving 40% during this launch, this is exactly what you will get. A comprehensive monthly report on the last trading day of every month, letting you know exactly what ETFs I'll be selling and replacing them with the next day. Access to the private members area, so you can see exactly what my portfolio holds, all the risk exposure analytics, and links to all of my communications with you. And you'll get to see firsthand in real time how a proven strategy works, with me putting $100,000 of my own money behind it, along with full transparent performance tracking, so you know exactly how my account is performing. And you'll also get access to the engine behind my momentum formula, and you can see what the top 100 ranked ETFs are in the market, according to my unique momentum formula, updated every Sunday. And so all new ETFs that I buy will come from within this top 100 list. Again, always holding a very diversified global portfolio. And so if you'd like to jump on board in time for the first monthly rebalancing this Wednesday, I'm sending out the first monthly report tomorrow night after US market close, letting you know exactly what 10 ETFs I'll be buying on Wednesday. Then click the link below this video, head on over to my website, click capital.io, and use promo code ETF40 at checkout to lock in a permanent 40% discount. And you can also use that on package deals as well if you want to get access to my stock picks and options trading chat room. Now is the best chance to do it because this code will be expiring this weekend. The portfolio is on fire, global momentum's on fire across many asset classes. It's a great time to start this strategy. And a huge thanks to everybody that's already jumped on board. I'm already getting lots of great feedback and I'm super excited to start this new portfolio on Wednesday. Thanks very much for watching. My name's Jared and I'll be back again this time tomorrow. Cheers.